What is going on, YouTube? It's Brendan from Market Makers. Guys, sorry for the one-day delay. I had to travel across my state. We had a family medical emergency yesterday, and everybody's doing well. Back at the house, I'm exhausted, but I listened to all of Powell's speech. I watched it. I listened to the nauseating Q&A session afterwards, and Powell lied to the American public. He lied to the investor class. He's going to cause a lot of people a lot of pain, and they're going to lose a lot of money. We're going to get into all that in this video. This video is going to be brought to you by SimpleFX. Guys, if you want to trade any of these equities, commodities, Forex, or cryptos, check out the link in the video description. You can trade anonymously there with only a VPN. If you're in the USA, throw your VPN in Mexico. You're in the UK, throw your VPN in Germany, and you have full access to trade all of these assets with USDC. $5,000 instantly available, up to $5,000 based on your deposit. You don't have to earn it, no games. Guys, check out that exchange. It's where I trade. It's fantastic. And let's go ahead and jump into the charts. So the VIX. Let's talk more about Powell first, shall we? Because what Powell did was very unethical. I've previously defended Powell. I've said, he's incompetent, like wholly incompetent, but that's no different than any other Fed head. They have 700 PhDs working at the Fed, and, they're like the smartest dumb people in the room, which is why we live in this world of economic theory that never seems to work out, like maintaining a 2% inflation level. That never existed prior to 2012. Ben Bernanke invented that. The same Ben Bernanke that didn't see the 3 Sigma housing bubble staring at him in the face when he said, by the way, the U.S. economy is very strong and the housing market's merely a reflection of the strong U.S. economy. And then what happened, guys? Housing bubble burst, S&P drops 57%, and everything got wrecked after that point. So the Fed track record's absolutely horrible. The reason I'm saying Powell lied, Powell gave a speech. He purposely omitted any mention of pain for the market, any mention of pain for the labor market. And he also reiterated the narrative of a soft landing, the soft, mystical, magical butterfly landing. He actually said a couple of times, the Fed still sees a path forward for a soft landing. Why is this a lie? This is a lie because the Fed's own Fed heads, they all say the gold standard for predicting a recession, remember a soft landing is having economic slowdown without a recession. The gold standard for predicting a recession is the LEI, the leading economic indicators by the Conference Board. That has you in a recession warning already since December, okay? Very, very dramatic where the LEI is right now. I'll show that chart on my next video on Sunday. But on top of that, guys, you have the yield curve inversion, which obviously the Fed tracks as well. 40-year high on the yield curve inversion, 3-month 10-year was at 60 basis points February 2007. It hit over 120 basis points in this cycle so far. And for the first time ever, we had a global yield curve inversion. So when the yield curve is this bad, when the leading economic indicators are telling you you're going into a recession, when you have market history of being above 5% inflation going all the way back to World War II, and the Fed tightening, raising interest rates, 100% of the time led to a recession, you're going into a recession. Okay, so Powell knows this. Now, why would Powell do this narrative of the soft landing, reiterating that? As a matter of fact, pushing back when questioned about economic conditions, financial conditions loosening with the risk-on environment. He's doing this because I saw the latest surveys. 71% of Americans expect to be in a recession or think we're already in a recession. And just like with the inflation expectations, remember Powell's deathly afraid of inflation getting rooted into the American psyche because you behave differently financially when you expect high inflation. The same goes true for a recession. You behave differently. You might not go out and buy 2 TVs for your house. You might not buy a new car. You might not take that vacation. So Powell wants to be in charge of bringing inflation down. He doesn't want to necessarily moderate your behavior, or he doesn't want you to control your own behavior and moderate that. So he's spinning this bullish narrative, whether he realizes it or not. And I 100% believe now he realizes it because everybody that watches the Fed expected 25 basis points and a hawkish speech from Powell. Powell did the opposite. As a matter of fact, two reporters questioned him in the Q&A section about the loosening financial conditions fostering this risk-on rally right now. Risk-on being your equities, your cryptos, and this is a major FOMO rally. Guys, this is a bear market rally. Powell pushed back and said, when they said, what about the loosening financial conditions? Doesn't that make your job harder? He said, well, yes, it would make our job harder, but to me, financial conditions are tighter than they once were. Guys, this is total BS because Bloomberg maintains the data set on this. They wrote a story. It's a published chart you can also go visit. But the economic conditions now are looser than when the Fed started tightening last March in 2022. Looser. This is why you're getting this rally. This is why on my screen you had the VIX drop all the way down to 17x. Okay, 17x. It got all the way down to 17.06. So this is what's happening in the marketplace. This is producing a major FOMO rally. And he was questioned by a second reporter, and he repeated the same answer. To him, financial conditions are tighter, even though all of the data, the metrics all say the exact opposite. Powell sat there and stone-faced lied. So either he's ignorant of the facts, which I don't think he is at this point, or again, he's lying to you. And by lying to you, he's fostering this massive risk-on rally. And what happens in these risk-on rallies? The narrative changes. The market changes. If any of you watch CNBC today, all of the money managers who, again, make money off the fees by investing your money, they're all out there saying, oh, this is great. This shows the Fed's ending near its end of its cycle. And, you can selectively buy stuff. You can buy stuff, rotation going back into growth. Look at ARK. Look at it was up, 20%. The Peloton's up. All the garbage companies are now up again. And it's all because of this rally. But guys, again, understand the macros, what we do on this channel. This isn't a bullish channel. This isn't a bearish channel. This is an economic cycle, trading cycle channel. And if you understand the macro, you are in a decaying environment with the leading economic indicators falling apart. Manufacturing, retail sales, all horrible. Consumer credit card debt at an all-time high. You have to understand this, which is why we can look at these markets, trade the movements up and down. But guys, you got to protect yourself. You got to protect your money and help your friends, family, people you care about protect their money. And that's what I see happening. None of this, obviously, financial advice. This is all education and entertainment. But let's talk about the VIX. VIX again spiked down. It's coming back up a little bit today. Guys, the market is moving up, and you have to look at how tight this is getting on the market makers caterpillar again. As this contracts, you're going to get an expansion. And when this is going to happen is when you cross the 50 simple moving average on the VIX, which is roughly 20 to 21. You cross that. If you hold that for support and move up, this is when you're going to get a massive VIX spike. And I'm not talking about going above 30. We've already done that. When we actually have a sell-off dump, which I do think was going to happen whenever this rally ends, you're talking about the potential for going above 40 or 50 on the VIX based on this contraction, based on market history, okay? So as long as the VIX stays low, and here's a S&P at the all-time high at 1634, this blue line, getting really close to that. The price can move up in these assets. Let's look at the S&P 500 on the 3-day chart, guys. Again, volume profile, including the all-time high. I want you to see where the key resistance is. Remember that 4,300 level if we continue to move up. There's one big hang up still for the S&P, and I want to show you this trend-based fib. We're going to do a larger wave projection here, okay? So you're taking your June 15th candle from last year, up to that swing high, come down to that swing low, 41.78, which is where you got rejected from by $20 or $30 right now. 41.78 is your strongest resistance remaining until you push up to that 43 level. Here on this fib projection, that would be the 1272 at 43.65. Depending how you pull your fibs, anywhere from 43.11 to 43.74 in that tighter fib projection I showed you. But this is the last hang up. So if price wants to break out from here, you'd be looking at something like price coming up, getting rejected, maybe coming back down, doing a retest, double bottom, and then moving up, making your distribution top, and then moving down, okay? That's if we get there. If we don't flip this 41.78, then this is your top. Looking at your volume on your 3-day candle, finally got an average volume bar. Nothing to write home about, again, because this is an average volume bar of a very large movement up here on the 3-day chart. Let's go ahead and open this up. Looking at our money flow index, one of our market maker indicators you do get as a gift if you join our Discord trading room. Those details in the video description. I was looking at the historical peaks here, including the all-time high of where the money flow can get to, and you're getting close. That's about 76, and the money flow is about 73.71. Getting very close. This may very well, 4180, may end up holding up with some overspill, possibly to like 4250, but watch and see if this area holds up in this bear market rally. Guys, you have to understand, again, you're not going to have a bull market when the economy is falling apart. It's never happened in the history of the country. So understand that. So as everybody gets euphoric and gets excited about investing your money, you wouldn't be giving them money if they all told you to sit in cash. But that peak volume resistance and that 4,300, 4,350 area, that's where this could go and top out if you do get some more upward momentum. Volume is nothing to write home about. Once again, it just doesn't look that great. Looking at the daily, why do we look at the daily 200, daily 50? 43% of all trading is done based on algorithms in the indices, okay? So some common algorithms are your 50 simple, your 200 simple. Your 50 crossed above the 200. The 200's white, the 50 is the multicolored. Crossed above your 200, giving you a bullish cross here, okay? So if we go ahead and back this up once again and do our trend-based fib, same exact area, so you can see this resistance and come back here. You can see once again the 4178 providing you resistance, and you look at your volume down here. Again, you know, your volume other than your last Fed wick December 13th, it's been consistently low. This is volume on the upside here. Look how much stronger the volume was, just the total amount of volume, okay? Not only just the size of the bar, which is representative, but you can see this, the total amount of volume, and then it peters out, you roll back down. You don't have that kind of breakout volume yet. Again, still a bear market rally. Where I'm looking at that peak resistance between this 4180 and 4300, this is just really your first key test to get there. And if we look at this on the MFI, on the daily time frame, again, you don't get overbought very often here. So you're just looking at these wave patterns. Your volume momentum, you got an uptick here, but I mean, look at the size difference in the rate of change here, okay? So your volume momentum still very low. Not a lot of participants, but enough people paying higher volume or paying higher prices for assets to drive the price up. You got a little spike here in the relative volume. Again, this may hold, guys. We have to watch going into next week. 4180, when I say hold, you can get above it, okay? What I'm talking about is being a key resistance quadrant. This may end up holding here, and this may end up being the death of your bear market rally. But if it flips it, we're looking at those higher levels to the upside. So let's see if there's any other indicators here I want to look at. If we look at our, let's look at our volume profile on the daily as well. So you can see this represented in the daily time frame. If we go ahead and pull this back out, yeah, I mean, everything depending, regardless of what time frame you're looking at here. Let's go back to the all-time high. It's way back here. There we go. So regardless of this time frame you're looking at here, you're looking at the 4365 area, 4350. This is where your strongest volume resistance is going to be. And guys, you know, with this pump comes a potential massive trade opportunity if we get into this gigantic cluster of resistance. Look at that. But you got to get through this cluster of resistance right now. And this is where you're hung up. Okay. And this is going all the way back in this bull run back into December of 2020. Okay, this is volume profiles capturing all of this volume, and you can see you're in this strong resistance area now, but there's a gap here, right? There's a gap, and price can get up there. You can get up to that 4,300, but to do that, you have to flip the 4180. So just pay really close attention to that. We'll go into more detail on the Sunday video. Let's jump over to the Russell. Russell, using that larger wave projection as well. Look at the volume on the 3-day chart of the Russell for this rally. It is absolutely horrible. Using this projection, we can see our 1 fib, the symmetrical move in the market, is 2027. And again, I'm looking at patterns, okay? So I'm looking at patterns here in the marketplace. And if we go ahead and pull this on the Russell, this gives you 100% retracement, right? Forming your first triangle. Reciprocal move for that would be, once again, 100%. So looking at price here, I'm looking at the Russell to potentially stop out in that quadrant of 2027, maybe get some overspill between there and the 2077 area. Let's see if the Russell comes up there and completes the symmetrical move in the marketplace. Again, and you know, if obviously if the S&P keeps pumping, guys, and goes to 4,300, the Russell is going to move up as well. Russell's been outperforming the S&P. This is a logical stopping point if this market, look at the volume. I mean, if the market doesn't want to continue this madness, right? Looking at the Russell here on the MFI, you can see a historical high here, not a historical, but going back in history, you can see where the high's been peaking out at, and that's up at 74. The Russell's down at 62. It has to get above these other previous peaks as well in the mid to high 60s. So this is just indicative of what's happening. You have a low volume rally. MFI takes into account it's a volume weighted RSI. So it's not moving up very strongly right here. And this may prove to be peak resistance for the Russell around that 2027, 2050 area. So watch that closely. Let's go ahead and look at some indicators here. Let's throw on our volume profile. Look at your volume profile where it's peaking out at right here. It's basically at that 1992 level. You're below the volume profile peak resistance. You got above it, fell back below it. So again, high resistance quadrant to look out for. Nice symmetrical pattern here and a high resistance quadrant. So the Russell is very fun to trade, guys. Lots of zombie companies, almost what, 25% last time I checked. Companies in the Russell cannot service their own debt, okay? So it's just a matter of time. It is a ticking time bomb. That is the Russell. Russell on the daily, want to focus a little bit more closely on the volume. Got a couple average volume bars. Again, look at the volume. Down, left to right. Price is rising, building volume divergence. MFI waving back to the upside here on the Russell. You have your bullish cross, your 50 going through your 200. So all of this is going to boil down to how long does the Fomo rally want to last. If the S&P wants to extend that run to 4350, Russell can have some more upside. Russell hitting a peak resistance quadrant like we just talked about right now. So this could be getting close to the end of the run here. Man, it's crazy to see what's happening in the economy. To see these indications of where the economic indicators are for manufacturing and for everything else, and to see that people are buying risk assets, guys. Just be well aware of this. Like I said, in .com, we had 6 or 7, 25% rallies. The Russell right now is up. It's got to be up at least 20% off this low. Let's see. We're up 22.81%. So be aware, this rally is all but exhausted itself. It can keep going higher with this massive volume divergence. It can keep going higher, but you get that key fib resistance to pay attention to. Watch the area you're at now at the peak volume resistance, that 1990 level up to the 2030 level. That's the key quadrant to watch. Guys, Sunday I will update you. We'll get into some more deep dive and patterns, talk about the macroeconomics, and I appreciate you guys watching and subscribing. Be sure to tick that notification bell as well. Talk to everybody soon. Take care.